Welcome back, everyone, to World FinTech Festival India 2021. And our next next session is a panel discussion on the new pyramid of financial services, financial access to unbanked, micro businesses, and women entrepreneurs. MSMEs are critical to the economies of many countries. Their numbers and values to employment are well documented, and the policymakers recognize these businesses are vital for economic development. Access to money is increasingly being seen as a critical impediment to their development or expansion. How are the fintechs in India tackling this challenge? Let's find out in this panel, which is moderated by Ms. Hansi Mehrotra, founder of Money Management India, who is joined by Mr. Raman, Taneja, Chief Product Officer with ARTH, Ms. Hardika Shah, founder and Chief Executive Officer of Kinara Capital, and Mr. Apoorva Sharma, partner with Stride Ventures. The panel is all yours, Hansi.
Hi, I'm Hansi. I started my career in financial services in the early 90s, so I've been doing this for a long time. I grew up in a small town in India, so I know India a little bit, but I then built my career outside India in Australia and then Singapore, and then I came back to India. I started my first stint in financial education back in the late 90s. That's when I kind of thought that retail needs a lot more financial literacy and education and a lot more help, and then kind of quit. And now I kind of write about investing in India. My interest in this topic is basically that I want to help. So I've been doing financial education, financial literacy, seminars, webinars, live sessions for mostly for women. I have attempted some in the lower bottom of the pyramid, but then quickly realized that I wasn't really helping, so I stopped. So that's my background. Let me just sort of go around the room and just ask everyone else's background before we jump into the meat of the topic. So Hardika, can I start with you? A little introduction about your background and what you're doing right now.
Thank you so much, Hansi, and thank you for having me. So I'm the founder CEO of Kinara Capital. Kinara is a socially conscious, systemically important non-banking finance company that is driving last mile financial inclusion for small business entrepreneurs in India. So specifically, we have built a digital lending platform that provides unsecured loans in the range of 1 to 30 lakhs to micro enterprises across manufacturing, trading, and services. And we have a high-touch, high-tech model. So we have physical presence, last mile distribution in over 3,000 PIN codes in 6 states in South and West India. And we operate on a fully digital, fully automated loan decisioning process, which allows us to make this product fast, flexible, and very, very timely. Within 24 hours, you can get a loan disbursed to you for working capital if that is what is needed by the micro enterprise. So we have done over 2,500 crores of disbursements across 60, 70,000 loans. And we're based out of Bangalore, but we have presence across 6 states, which we are we're looking to expand. Around women entrepreneurship specifically, we have created a Hardika's program that is to promote women entrepreneurship. And it's a combination of a discounted interest rate with support with business education, planning, networking services that helps women entrepreneurs to grow their business. So that's really all about Kinara.
Wow. Okay. But I wanted to know a little bit more about you as well. Just one line. What's your background?
I am an accidental banker. I spent 20 years in consulting globally and decided this is where my passion was.
Right. Okay. Right. So at least you found it. Mine, I'm still looking. Thank you. Thanks. Thank you. Let's then go to Raman. Maybe a little bit background about yourself and then also a very quick intro about your company.
Well, thanks, Hansi, and everyone for the session. Myself, Raman Taneja, so I'm part of ARTH Financial Services. My mandate here is to create tech-led products and to create impact at scale. About ARTH is basically, I'll say, the MSME FinTech company, and we're registered NBFC. We reach out to both women and men, but primarily to the women customers. We already reached out to 3.5 lakh micro entrepreneurs who didn't have access to financial services. And our customer base is across the country, and we have serviced 18,400 PIN codes across the country.
Right. Okay. Thank you. May I now come to Apoorva?
Hi, Hansi. Pleased to meet all of you and thanks for having me here. I'm a partner at Stride Ventures. It's a Cat2 AIF. It's a venture debt fund. This is our second fund journey. So far, we've invested in about 45 new age companies across sectors and stages. The idea is to bring startups under financial inclusion and offer them various products, either it's for working capital or capital expenditure or acquisition financing or simple runway extension, dilution prevention products. We also have an NBFC of our own. The idea of the NBFC is to do enable supply chain solutions, financing solutions for these new age economies and co-create programs for their vendors and suppliers. In terms of my personal background, I come with over 8 years of experience now. Started out with investment banking in HSBC, then in the debt capital markets and M&A advisory team. Then I was part of Xander Finance, which is an NBFC, the credit platform of the Xander Group. And I've been a part of the Stride team since day one.
Right. Okay. So thank you for those introductions. Now let me jump into, I guess the title of the session was providing financial services to the unbanked, the MSME, and women. Now, to me, there are three very, very different segments, right? The unbanked are people by definition who don't have a bank account. So that's very much the bottom of the pyramid. Then there's the MSME, which I thought covers pretty much a big chunk of the Indian market. I would have thought, because the definition I looked up was up to 250 crores revenue, I think. And then there's kind of like the women, which as even in the HNI space, we sometimes laugh and why women are a separate segment. I mean, they're half the population, so why should they be a separate segment? But here we are. So can each of you just sort of maybe quickly remind me of what is the specific service that you offer, which one of these three segments that you offer, and why you've chosen that particular segment to go and service? So Hardika, maybe I'll start with you again.
Yeah, sure. So yeah, let's talk about that expands, right? There are 65 million MSMEs, and we talk about this as a very large number and a very large definition of MSMEs, but 90% of them are actually earning less than 5 crores in terms of annual turnover. So actually, when you think about it, most of them are micro enterprises, not even small, and very few medium. And when you look at the challenges of micro enterprises, they tend to be less formal. They have less documentation, definitely lack of collateral, access to capital is challenge. And that is the segment that we are servicing. We are providing essentially unsecured business loans to micro businesses, micro entrepreneurs, and they can be women. In fact, we focus on women, and we would like for more women micro enterprises to become more formal and get more access to credit. And that's how we are expanding the financial inclusion footprint.
So what would be a typical example of a borrower for your business?
Any small scale micro manufacturing business that's in the auto component, machine components. They could be doing auto retreading and services. They could be selling auto parts. They could be traders of food and fashion. Anyone that you can think of in your own neighborhoods today is a customer of mine.
Okay, and how would they find you? Like, how do they know that you exist?
Yeah, so our customers, they can find us online digitally through ads we run, and we have last mile distribution. So our own field teams are out in those areas working with customers, and we get a lot of referrals from existing customers, because unsecured business lending is really a rare commodity for this segment. And so we source through our own feet on street, we source through digital channels, and we source through customer referrals.
Okay, just a couple of more questions. So, and you said they're for business use. So you very much are in the business loan segment, right? Indeed. So then there's no question of lending to groups per se. You're not in the microfinance sort of space at all, right?
Correct. So, microfinance lending especially in India, it's roughly 8 to 10,000 rupees. We lend from 1 to 30 lakhs. Average loan amount is around 4 lakhs. So we are definitely way beyond the microfinance segment.
Right. Okay. Raman, could I ask you the same question? What segment do you focus on, and why have you chosen that segment, and how do you reach out to them?
Okay, so we focus both on women and men. So primarily we focus on women. From a TG, from a target group point of view, we reach out to Kirana stores, we reach out to pharmacy, we reach out to saloon, we reach out to dairy and farmers. So these are the main segments we cater to, as well as the payment companies who basically provide financial inclusions. I'll say the BC, the business corresponding agent. If the person requires a working capital loan, so we provide that. So our ticket size, the average ticket size is 70,000 rupees, and we look at a segment where the overall revenue for the person or the entrepreneur is 1 million.
Sorry,
So
I missed this.
the
I missed the last
overall
bit.
turnover, we look at the 1 million. And how do we reach out to RTGs? We have both the distribution, which is the physical distribution, as well as the digital distribution. We have our own sales network who reach out, then the entire the onboarding happens. And then the reason why we do that, Hansi, is that there's a reason the physical distribution is there's still I'll say the segment within the overall TG who still not have adopted to the digital means and the tools and the channels. So they require a bit of assistance. So our field goes to them and they educate them how the loan can be dispersed and what are the processes to. It's basically an assisted channel where our staff helps them to onboard in a very seamless and frictionless manner. Apart from that, we also work with many aggregators where the distribution happens pure digitally. So we have an app, but it gets connected to all the aggregators, food aggregators and pharma aggregators, and the links comes to us, and the entire journey happens on our platform, and the money goes to them on the same day.
Right. Okay. Raman, can I just ask you to move closer to the screen because I'm having trouble hearing you. Okay. So I don't know whether other people have the same issue or not, but I missed some segments. But anyway, so Apoorva, let me come to you now. I'm assuming you are a venture, well, not assuming, you said you're a venture debt provider. So can you give us maybe an overarching sort of picture of how you see the Indian borrowing market? It's obviously a very big market. We are always starved of capital. So how does a firm like yours see the whole borrowing segment? How do you divide it, and what segment have you chosen to play in?
Sure. So Hansi, as a venture debt provider, we are essentially lending to growth stage companies in the country today. And India is the fastest growing fintech market globally. There are about 2,100 startups, and this could be, digital lending, of course, is the major pie of it, and most of the money is made there. So it could be any digital lending platform, either personal loans or business loans to SME enterprises, etc. But there are also B2B SaaS companies for, say, collection as a service, or some open API infrastructure for integrating banks with startups. There could be some, and also, in the app-based lending, there could be on-balance sheet for which there is onward lending through us. So we fund them, and then they find their customers that they want to lend to. There could also be co-lending platforms where they're using the balance sheet of the bank to lend. So there could be startups like that. There could be payment companies which we are lending to. There could be BNPL players. There could be neo-banking players. So our ambit in that sense is very open. We are open to help all of these fintech startups in their initial journey, because a lot of fintechs which have to use the balance sheet, which eventually borrow from NBFCs or banks, there's a certain learning curve, because first your credit engine is just getting suited and your loss ratios are higher and you're not profitable. And then venture debt plays a very important role to capitalize your balance sheet. So any of those things, all of that is open to us, and we don't have a specific segment as such, but we have done a lot of companies in app-based consumer lending and also MSME lending. But I'll answer this question in two parts. There's also the second segment which Stride does, which is the NBFC that we have. Now, that is the more interesting part, in the sense we are reaching out to the end consumer, the end credit borrower, the borrower, exactly, right? So there could be lending to the vendors or the dealers of the startup. So our underwriting is on the startup is our anchor. But there could be a lot of supply chain financing solutions which is completely broken for new age companies. There is no credit available to, say, the suppliers, or it could be a SME supplier, or it could be a farmer, or it could be a driver on the platform of this startup, right? So a logistics startup could have hundreds of drivers which are on board the platform. There could be a dairy tech startup which has thousands of farmers which are suppliers to the startup. So it is lending to those guys by my underwriting on the anchor. So I have comfort on the startup, which makes me willing and able to lend unsecured lending to these farmers or drivers or SME suppliers on the payable side, and to the end customer or the distributor, the dealer on the receivable side. So we are taking care of both the legs of the startup from the NBFC, while any kind of on-balance sheet lending to the startups is done out of the AIF that Stride has.
And sorry, the bit that I missed, out of this AIF, is it just a lending-focused AIF?
Yes, this is a debt AIF, Hansi. Yes.
No, it is a debt AIF, but you could be providing debt to all kinds of startups. What is the proportion that you're focusing on this borrowing-based startups?
Sure. So about 20%. So it's sector agnostic, right? But about 20% of our corpus would be deployed in fintechs. Now, in fintechs, there could be various segments, right? So obviously, app-based lending would be the dominant player there. Digital consumer lending would be the dominant player there.
Okay. So 20% of the fund. Okay,
yes.
So let me just jump into the meat of the topic, which is basically, if all of you have chosen to be fintech players, I assume that something changed the market for borrowing in India has always been there, right? People used to go to money lenders and borrow money. I know my family certainly has and has not had a very good experience. So the demand for credit was always there. How are you guys seeing what has changed, and how are you sort of describe the challenges both on the demand and the supply side? Again, Hardika, let me start with you. What has changed the last few years? What are you doing? What is different? Why should people maybe invest in you, for example?
Sure. Well, first of all, I think your observation on the demand being high is so accurate. They're saying this demand is 400 billion and growing at 11% or higher every year. And this is the IFC saying it. So that is a pretty massive number when you think about it, right? And that's all for the micro enterprise or MSME sector, MSME segment in India. Now, when you look at what has changed, what are the things that we have to acknowledge here is the role of the regulator and the ministries in building the digital infrastructure and laying down the rails that did not exist. And frankly, we are certainly way ahead if you look at all other countries around us in what this means, right? And so when we talk about as simple as a UPI platform and what it has done for us as a nation and the number of transactions, last I heard we were at 3 billion, maybe it's more now. That is pretty phenomenal. And part of that digital infrastructure is to move towards the presence-less, paperless, a cashless economy. And so what it has done fundamentally is collapse this divide between India and Bharat. And when we start talking about what digital is to this universe of micro enterprises, we are seeing in our customer segment and micro enterprises that are leveraging digital, not only for collections, payments to them or payments for their suppliers, etc., but also outreach to customers in getting access to markets that they didn't have before. And that's a shift from where they were. And what we recognize for us as, at Kinara, one of the big changes we did, and of course, the India Stack is a great example of how a small enterprise or any enterprise can plug into, and NBFCs like us can plug into and really move the bar, right? When we talk about eKYC or digital signing, it just takes away quite a lot of that load of people in person, original sign and verified and going into paper forms for signatures and stamps and all of that. I mean, just imagine the effort we spent doing that before and what we do now. It's fully digital. It's a sea change that is happening in terms of lending and how lenders and borrowers are interacting and how that seamless process can really expand to new opportunities for both sides.
Okay, so what we're talking about there are two things, right? Which is the JAM Trinity, the Jandhan, ARTH and mobile, as well as the India Stack, right? Which is the paperless, presence-less, and whatever. Now, the question that I'm asking though is, and this is just my very limited experience, when I go somewhere to pay, yes, they have these QR codes, stickers everywhere, and I have the option to pay digitally. but most of the time they still sort of say, oh, pay me in cash. That's just my experience. I'm just asking you, maybe Raman, you could comment on this. What are the challenges in, I mean, assuming that your whole premise is based on all the cash flows being digital, that you can track, and therefore you're able to do collateral-less lending. So you need to see the cash flow track record, and you are then making some judgment call. What if they are still not sharing that cash flow? And what are you doing about it?
If we have to look at two lenses. One, of course, when we talk about the digital lending, when we work with various operators, basically the food aggregators, pharma aggregators, so we get a lot of transaction data. So based on that transaction data, Hansi, we underwrite the entire, I'll say, the cash flow of the consumer, and we lend them. So that's one piece that's still an easy, I'll say, thing to handle. But the other side, just to add one more point, Hansi, here is that 50% of our customers are new to credit customers. So this is where we do a lot of heavy lifting. As Hardika was also saying, that to a certain extent, we have solved the onboarding challenges through public APIs, Aadhaar, JAM, account aggregator, GSTs, and all things have come into the place. So there's still a segment who are new, they are still getting into digital mode. And the good thing is that post Geo coming into the picture and the telcos revolution, everyone has more or less access to WhatsApp. So this is one of the channels where we reach out to them. And we basically see that the entire communication happens to this particular channel, and we are able to onboard them. Just to give an example, for the customers who are still new to credit, as I was mentioning earlier, fleet on street, they go to the customer's place, they understand the entire, I'll say, the area around it, I'll say the context around it, how big the shop is and how much sale is happening. So he's by his own eyes. And some of the other proxies we also see as a part of our onboarding process is that where exactly the shop or the business is located. Is it in a mandi, is it in a wholesale place, or is it away from, I'll say, the main access of the road? And then there are some templates which we work on, predefined templates, which basically says that if this is the particular context of the shop, what does the sale overall looks like? So while we go ahead with the declaration of the customer and we go by that, but there are some proxies, we work on that, and we harmonize the overall data, which is basically the data which we have collected ourselves, plus the public API data is what we have. And finally on go ahead and we lend to particular customers. One more thing we do as a part of our due diligence, Hansi, which we feel is very important, is that when we reach out to the customer, we again make call to the customer to understand whatever information that has been provided to us is more or less correct. So because it's more on a declaration basis when we are talking about new to credit customers. So once the call goes and we get the confirmation, then the entire onboarding process plus the disbursement process starts. So in a nutshell, tech is there. If you see the way the MSME and the FinTech segment is growing, it's now, I'll say, a movement for tech-based products, which basically eases out the overall onboarding process. Because this is the whole in the entire lending, the onboarding was the most difficult, I'll say, the task because of the absence of data that has been more or less solved. Now the only thing is that how easily you are connecting to the customer on a more frequently basis, you are getting the cash flows in a digital manner. So that next time when you go to the customer, you need not to go through the KYC process. You have to just underwrite based on the new cash flows or the existing cash flows or the new cash flows once you've given the working capital loan and underwrite, which basically builds a building block for next lending line for them. And the entire heavy lifting, Hansi, just to conclude on this, heavy lifting is done by machines. We work on AI ML model, which keeps on training based on the customer data, and it keeps on revising the limit wherever it is applicable.
And just to fill me in, how much like data did you need to collect over what period of time to be able to build the AI engines?
So well, so we require minimum 6 months of transaction data, especially on the digital side. And as I said, when we, in the absence of data, especially on the new to credit customers, we go by the declaration, what the customer says. And we also work a lot on the public API data. So just to give an example, in terms of data point, we capture, of course, the KYC data, which is one of the main thing which we have to think about. Apart from that, the social data, how many family members are there, what is the overall revenue, and what business you are in. And the way and very good question, Hansi, on this side. We keep on asking data more from the customer, but the whole point is that over a period of time you have to think about your own templates, which says that the moment I put this customer profile into one of the template, and what does the overall balance sheet looks like. So then we need not to ask everything from the customer. Let the machine takes most of the work and suggest us what should be the limit for the consumer.
Right.
And see, this is I mean, this is really quite, where I think all of us digital lenders are going, right? The biggest challenge has been the data. And you're right, when you go and people say pay in cash, what do? This is why Raman, what he's talking about is very valuable, right? We do need the last mile. You can't just get away yet for this segment without having the last mile in our case, doing what we call data enrichment. They are out there capturing that exact information, their cash receipts, the cash transaction information, bolting on the digital information, whatever is coming through the bank, partial, or otherwise, and any additional information to build out that AI ML models, or those models, not one singular model, obviously. And, in our case, over 100, 150 variables are taken into account that are at the company or the business level, the person level, and other internal and external information to make a final, unified decision across the experience of our experience of dealing with this customer segment.
Right. So Apoorva, when you're looking at these fintech opportunities to invest in, what are the differences that you see in the way they approach this data problem? Everyone can say AI, ML, I'm sure everyone's using it, but I'm just asking you, do you see a difference in the number of variables, the quality of the variables, and do you see a difference in the outcome? So what I'm asking is indirectly, how important is the choice and the number of variables that they pick, and how important is their data on which the AI ML is trained on? And are you seeing variability in the outcome of either how quickly they lend or the recovery in terms of NPAs?
Sure. So Hansi, I think in the consumer lending space, there are a lot of alternate data sources that people are getting access to, especially for the new to credit consumers. So these could be, say, the number of debits or credits in your bank account, or what kind of apps you have on your phone, what is the model make of the phone that you're using, what kind of promotional offers, wallet messages do you have, other kind of demographic data, phone data. So a lot of these things are there, and people have collected it over a period of time. Of course, there has to be agility in just kind of retraining your AI ML every time something goes amiss and you go and retrain yourself. There's some bit of course correction which is required. But I think a lot of companies have come out with very good data analytics solutions, and that is very clearly visible in their vintage charts, collection efficiency, rollback rates, etc. And COVID was a very testing time for all these largely digital lending, or I would say minimal physical intervention, minimal physical verification. Everything was happening digitally, and COVID has kind of separated or polarized, investor interest and the kind of companies in terms of the strength of their AI engine. So there are some companies, of course, everybody suffered losses, and the NPA ratios kind of shot up, and that's inevitable. But a lot of them I'm seeing have bounced back. There has been a steady increase in disbursements, steady increase in bank tie-ups, AUMs, the collection efficiencies are back on track, NPA ratios are below 5%, a lot of them. And so one is obviously your moving NPA, but even your static steady state loss ratios are improving. So I think with that respect, India is very advanced in that sense. A lot of companies have course corrected and modified their AI engines. And of course, some companies who are more sure of their credit underwriting engine. So that what we've seen in the market is there are two models, right? One is that you use your balance sheet for lending and you take the entire risk and you take the entire return. And the other is that you block some FLDG with the bank participant that you have. So the fintech companies which have been able to demonstrate their asset quality for a sustained period of time, there has been massive reduction in the FLDG that they have, the first loss default guarantee percentages that they have been blocking with the banks. and massive reduction in the cost also. And I think the moment that happens, then inherently it becomes a very positive ROA business, which obviously attracts investor interest as well.
Okay, Hardika, do you want to add anything to that in terms of variability of outcomes depending on what data how many points and the kind of data and the kind of data training you need to do?
Yeah, I mean, look, data, I think data is not one just blob. It is a blob at a point in time, right? And the variability comes very much from both how the customer business is operating, how the sector segment is operating, and also how we are seeing over time the repayment behaviors, the collection efficiencies. And of course, the biggest challenge with training the model has been the pandemic, because how do you account for such a mega event and train a model in a way that it can make sense of it, right? So we have had to really create micro models and bolt on different pieces intelligently to come up with the best loan decision and calibrate for what a COVID situation might have done before, during, and hopefully now going to post. And so it is it's a constant challenge and experience, and really that's what makes it fun.
Right. So if I put my investor hat on now, and I want to invest in this sector, first perhaps as a lender, what kind of returns will I get from being an NBFC in this sector? That's to you, Hardika and Raman. And then Apoorva, for you, what if I were to invest in your AIF? How would that returns be different? So I'll come to you in a second, but Hardika and Raman, what would be the returns if I were to be an investor in your outfit?
Yeah, I mean, look, the good thing is that at the underlying of all of the digital and tech, we are talking about a business that is well understood, and investors understand that a good operating business, for example, Kinara Capital has been profitable for 6 years, including the last 18 months as well.
Not the company. So I'm a lender, right? So I want the returns so that you can lend it out. So yeah. I'm assuming that
the cost of capital. So, our lenders, our cost of capital, and this will change as organizations will move and have ratings and what have you, right? Our cost of capital is anywhere around 12-13% today, right? And over time, it will decrease. So that's what a lender who is lending to us could look for.
Right. And do you see that cost coming down? Do you see NPAs coming down as we sort of get better at this? And the other question I wanted to ask was, what does technology not fix? So yeah. What have you seen are the challenges? If you quickly sort of comment on that, and I'll come to Raman next.
Yeah, I mean, look, do I see the cost coming down? Absolutely. The lender cost is really driven by rating. The more banks get on board, the larger we get, the more history we have, the profitable history we have. All of these will play into ratings, and the ratings play into the rates itself, right? So yes, I do see that coming down. In terms of your second question of what does technology not fix, technology doesn't fix the last mile personalization that is required. That what Raman was talking about earlier about, helping the assisted model. It does not fix the fact that I have all the perfect documentation, but there isn't a business in sight. There is no signboard, there is no table, there is no operating machine, there is nothing. It doesn't fix that. So we have to, for this segment, for our nation, think about a blended tech model for a little while before we can think of a fully hands-free, presence-less solution, which will come, but not immediately.
Right. Thank you. Raman, your comments on the cost of capital and non-technology fix?
Well, the cost capital, as Hardika suggested, goes to the same range, only 13 to 14%. So what we have in our hand, and we hope so as we move forward and with the situation easing up, the overall sector is opening up. So there's a lot of efficiency coming from the lenders where the overall rate will go down to a certain extent. So what we have in our hand on the other side is that how do we bring the operational self-sufficiency, and how do we basically improve the overall operational cost, which means that how quickly you're basically churning your capital, how quickly the money is moving to the customer and it is coming back. And most of the things can be solved by technology, as when we were delving up earlier, that the KYC thing, it's solved. There are still some pockets where the KYC, I'll say, though Aadhaar works, but the linking of Aadhaar with the mobile number is not there. But you can always use biometric and you can get it done. So there are more operational challenges. But these are the levers we at ARTH we are working on, and to ensure that we stay within our margins. Just to add more to the process is that we have been working on it. In fact, that how do you basically ensure that once the KYC is done, we need not to go back to the customer for doing a second round of KYC unless regulation asks us. So what it basically does is that the customer enjoys a perennial limit for a year or two, and the money is available on tap as and when customer wants it, provided certain conditions are fulfilled. So that helps us a lot, to reduce the overall, I'll say, the customer acquisition cost, which is one of the first cost that we incur as a part of our onboarding process. Rest, we feel, as Hardika was saying, that we need to still do a lot of work on the personalization part, and the recording of the local context. Though the person is there, he's entering the data, and finally it takes the shape of columns and records in the DB. But the personal context, and as well as I'll say that the overall the local context, that's still to get converted into, I'll say, the digital mode, or I'll say the digital tokens more precisely, so that tomorrow when we see that if those inputs also come into the picture, so that makes a lot of I'll say the onboarding process easier for us.
Right. So Apoorva, question to you: what kind of returns, and to what extent are you seeing interest in investors, institutional investors, or HNIs for that matter, wanting to invest in this asset class? I know there is a whole bunch of interest in ESG, and I guess green, the environmental part gets all the attention with green bonds and things like that. But I would have thought that the social impact of lending to the unbanked or the MSME or the women market might also be generating interest. So are you seeing interest? And if so, what returns are they asking for, and what can you deliver?
Sure. So Hansi, I'll just talk about how we look at, we generally try to have chart and ROA of the company that we are lending. So typically we have seen all fintechs in India, at least the ones that we've been speaking to, and now have been a lot of them. The general IRRs that they would be earning would be anywhere between 25 to 30%. And then they have to account for their customer acquisition cost, their credit loss, and also cost of capital and certain bit of operating expenses, right? Which would be credit cost, collection cost, etc. So typically after all of this, the standard that we've seen in cost of capital is anywhere between, say, 11% to 15%. We are probably at a little higher side. So whatever is the cost of capital for these fintechs is the return for us. So we are at about 13 to 15% return that we are seeking when we lend to fintechs for onward lending. That would be the range. And I think in terms of equity investor interest, I think fintech has gained massive momentum. There are a lot of VCs which are specialized in financial services, a lot of generalist VCs that have seen India, transform itself with the open architecture like UPI, GST, account aggregator concepts, and just the general boom in digital payments and adoption of digital payments. So I think now it's not only a certain type of investors, whether it's institutional or family offices or HNIs, all kinds of investors have seen India transform the digital landscape, and we see interest from all these guys. So all classes of investors.
So much, we're out of time. Thank you so much again, and look forward to seeing you guys again. Thank you. Thanks so much.
Thank you so much, everyone.
Thank you. Nice to see you guys. Bye.
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 Thank you, everyone. And we would have loved to listen to this conversation go on, but time is the enemy here. With that said, thank you very much, everyone, for joining us despite your busy schedules. We hope to see you again very soon. And with that, for the viewers, we move on to our next session. And please do not forget to refresh your web browser. We'll see you in a moment's time. Thank you.
Thank you.
Thank you.